Hello friends and welcome to my YouTube channel Simply Stocks, and today I'm going to talk about DHANUKA Agri which is coming at a very attractive level. So let's understand about the business. Let's get started. First of all, a disclaimer that this is not a stock recommendation. People taking any position to any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. Before I talk about DHANUKA Agritech, here's a small request that kindly support me on Patreon, and once you do that, if you help me grow the channel, help you also ask me questions and eke out answers in greater detail. Once you get the $10 membership, you'll have access to my portfolio, my watch list, and number of podcasts I'll put up from time to time. And also, if you can pay $100 upfront, you get 1 year access by paying for 10 months. For detailed market or company talk, you can directly email me and we can work things out with a fee. Now about the company. Established in 1985, DHANUKA Agritech manufactures agri inputs comprising of crop protection, chemicals and plant growth. It is a top brand in this segment of agrochemicals, and over 40 products with brand names in various domains for crop protection are being sold by the company, like herbicides, fungicides and pesticides. It is a prominent national player in this segment. If you look at the financials, then sales were up 15% in the March quarter this time around, whereas profit grew by around say 10%, not 43%, but around 10%. So the profit growth was not that great. So it's not 43% but 10%. Virtually debt-free company. High institutional and promoter holding with only 9% free flow, so that's a big positive. Return on equity of 17% is pretty decent. Margins at 20% has declined from what it used to be, which was around 24-25% about a couple of years back. So basically margins declined because of high cost pressures. And talking about the performance of the stocks, the stock has done nothing over the last 4 years. It hasn't performed that well. In fact, it has been around this 650-700 range 4 years ago as well, around 2018, and it is in the same range again. Numbers have been good, numbers have been robust. So what has happened is that valuations have become attractive over this period. With the stock not moving much, it has become one of the best agri plays with the kind of portfolio that it has. Sales and profits have both done well in a difficult circumstance, in a very difficult environment of high cost pressures, and valuations are now reasonable as stock has consolidated over months, as I explained. So what has happened is that we have a greater EPS than what it was 3-4 years back, but the stock is trading at the same 650-700 range. Strong operating numbers and healthy dividend payout is also a big positive for the company. So why I believe it is a buy on declines? It is a market leader in its space. A number of top brands are selling across India and is one of the best companies, and with high, you can say, demand for agri products and agri inputs going forward with better monsoon probably in the years to come. This is going to be one of the better sectors to invest into. Will outperform as rural economy recovers going forward, and the recovery in tractors is a positive signal. So what we have seen with Escorts and Mahindra is that the valuations have been becoming very good, and that the performance of the companies have been much better in the agri space. On an average, you can say used to trade at 50 to 60 times EPS, and currently it is trading at 35-40 times. If you look at the technicals of the stock, then there is strong support between the 650-680 regions, which is the current level. It may not fall much from here. Probably 610-620 would be one of the levels probably where one can keep a stop loss. And stock has fell vertically post economic shutdown in 2020, and stock has not moved much, although numbers have been very strong for the company. Long-term stop loss can be around 610 levels and can give consistent returns over long term if somebody can buy between the 600-650 range. So, in my opinion, what you can do is probably buy on major declines and at current market price and keep track of numbers. If you have a 4 to 5 year viewpoint, then the stock is set to do much better. It can give you a good 17-18% CAGR return if things fall in place with respect to rural economy as well as with monsoons, and have less than 5% exposure into such stocks. So this was a video on Dhanuka Agritech. Please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it, and kindly support me on Patreon. Thanks a lot for watching.